Welcome to the deep dive. Today, we're doing something a little different. We're going to move past just the headline S&P 500 number and really pull back the curtain on the actual market plumbing. Our whole mission here is to walk through the framework that a senior portfolio manager uses to assess risk and position for the week ahead, focusing everything on the close of Friday, December 5, 2025.
Right. It's the difference between, just seeing the scoreboard at the end of the game
Yeah.
and actually understanding the playbook that got you there.
Exactly. And the context going into this close is just so important.
It is. We've been in this very tricky kind of neutral sentiment environment.
Yeah.
The S&P, the Nasdaq 100, they've had a nice run to one-month highs.
And that's been mostly fueled by really strong Q3 earnings, right?
Oh, absolutely. We saw something like 83% of companies beat expectations. That drove, a huge 14.6% year-over-year jump in earnings. So the fundamentals look good.
And the market's already looking ahead. It's pricing in, what, a 95% chance of a rate cut at the next FOMC meeting?
A 25 basis point cut, yep. Almost a done deal in the market's eyes.
So if the whole backdrop is this sort of neutral optimism, we're not looking for some obvious panic signal. We're hunting for this subtle stuff.
Precisely. We're looking for signs of real conviction or real caution hidden in that final hour of trading. The key question is this: are institutions actually putting fresh capital to work to drive this thing higher, or are they quietly using this strength to get out?
And that all comes down to the microstructure.
Exactly. The interplay of liquidity, volatility, and the proprietary institutional flow data right at the bell.
Okay, let's unpack that. What's the absolute first analytical check that runs on a PM screen as the market closes? Before we even look at a single stock, what's the health of the machine?
It's all about liquidity. That is paramount. We immediately look at two things: bid-ask spreads and market depth, especially across the really big liquid names in the S&P and Nasdaq.
And what does that tell you?
Well, tight spreads and deep order books. That signals sustained institutional confidence. It means price discovery is efficient, the machine is running smoothly.
And if that liquidity suddenly dries up in the last 15 minutes?
That's a huge red flag. If you see spreads widen out significantly, it means market makers and institutions are pulling their bids. They're getting hesitant.
They're essentially saying, we don't want to hold risk overnight at this price.
Exactly. We aren't interested in providing cheap inventory up here. It's a sign of caution.
And the execution itself tells a story, doesn't it? It goes beyond just the final print. We hear these terms, VWAP and TWAP. Why does the quality of the execution matter so much?
Because for a portfolio manager, performance is everything, and it's all measured against a benchmark. Algorithms like volume-weighted average price VWAP are tools to execute enormous orders without disrupting the market yourself. Beating that VWAP is a measure of success.
Okay, so if the price closes way above the VWAP on heavy volumes.
That's a very powerful signal. It means big money was so eager to buy that they were willing to pay a premium to the day's average price.
They were aggressive.
Very aggressive. That confirms accumulation. It confirms conviction in the close.
It's also interesting how the game has changed a bit. That pressure to get everything done by the 4 p.m. bell has eased with the rise of 245 trading.
It really has. A hedge fund can now find liquidity in London or Tokyo hours if they need to. That traditional 4 p.m. liquidity rush isn't as critical as it once was.
Which can actually mask what's really happening.
Right. It forces you to look deeper into things like dark pools to see the real institutional hand. We'll get to that.
Agreed. Okay, so let's pivot from the health of the system liquidity to decoding market anxiety. This is where it gets really interesting for me. Volatility. It's not just about if the market is scared, the spot VIX. It's about when it expects to be scared. The term is structure.
So the spot VIX for December 5th, hypothetically, was sitting at 16.5.
Which is middle of the road.
Completely. It's in that neutral zone. It's not complacent. That would be a reading down near 12. But it's definitely not panicked. The market is basically comfortable.
But the real story is in the term structure. Can you explain Contango and why it's the normal state of affairs?
Sure. Contango just means that longer-dated VIX futures are more expensive than shorter-dated ones. Think of it like buying insurance. It costs more to insure your house for a whole year than it does for just the next month, simply because there's more time for something to go wrong.
So it suggests a stable outlook.
It suggests a stable, healthy outlook where fear is expected to stay low in the near term.
And the opposite of that, the big stress signal, is backwardation.
That's backwardation. And it's rare. It happens less than 20% of the time. It's when the market is willing to pay a huge premium for immediate protection.
So short-term fear is higher than long-term fear.
Exactly. It signals acute, present moment stress and massive hedging demand. It's a critical red flag.
And what did we see on the 5th?
Well, the curve was in a moderate contango, which confirms that overall neutral feeling. But, and this is the key detail, it had flattened slightly compared to earlier in the week.
Ah, okay. And that slight flattening, that's the subtle signal the pros are watching.
That's the signal. It tells you that even though the VIX level is stable, the perceived risk of an immediate spike is creeping up. Just a little. Confidence in prolonged calm is just starting to wane.
So if that curve keeps flattening.
If it keeps flattening towards backwardation, it means people are quietly buying up cheap front-end protection, getting ready for a surprise. We also watch the VXV-VIX ratio for that. It can often warn you of a spike days in advance.
All right, let's move on to participation. We have a market with efficient execution, a kind of neutral mood. How do we know if this run to a 1-month high is a real robust move or if it's just, 5 mega-cap stocks dragging everything else up?
That's where we look at market breadth, specifically the advanced decline line, or the AD line.
Yeah.
A truly healthy rally has to be broad. You need the vast majority of stocks going up, not just the index heavyweights.
So if the S&P 500 hits a new high, you need to see the 80 line hitting a new high right alongside it.
You absolutely have to see it confirm the move.
And the warning sign is when they diverge. The S&P looks great, but the AD line is lagging behind.
That divergence is a classic warning sign. It signals a narrow, potentially fragile rally. And, well, that's exactly what the data was suggesting. The rally looks narrow.
How narrow are we talking?
The AD ratio was only just barely positive. It points to some pretty lukewarm participation and a heavy reliance on a small group of those large-cap stocks.
But is that really a red flag anymore? I mean, given how top-heavy the indexes are, isn't a narrow rally just the new normal?
It's still a risk factor, a huge one, because that narrowness exposes you to systemic risk, which leads you right into the danger of correlation breakdowns.
Right, when diversification just stops working.
It just stops.
Yeah.
A correlation breakdown is when assets that are supposed to hedge each other, like stocks and bonds, for instance, suddenly start moving in lockstep.
And that completely undermines portfolio construction.
Completely. There was research out in September of 2025 showing hedge funds were already seeing record-high correlations to the S&P 500.
Yeah.
So if everything sells off together, the downside is magnified.
And we are seeing early signs of that now.
We are. It's subtle, but you're starting to see breakdowns within certain tech subsectors and industrial commodities. They're moving together more than they should, which suggests these big concentrated flows are just overriding everything else.
So just to recap, we have a system that is healthy on the surface with good liquidity. It's a little anxious with that flattening VIX curve, and it's all leaning on just a few stocks.
A pretty good summary.
Okay, so now let's track the whales. How do portfolio managers spot what the big institutions are actually doing in the final hour, especially when they're trying to hide it?
For that, we use a combination of volume price analysis, VPA, and dark pool data. VPA is all about finding divergences between price and volume. For instance, accumulation, that's buying. You'd look for sustained upward price movement on increasing volume. That's conviction.
Or consolidation on decreasing volume.
Right, which suggests institutions are just methodically sweeping up shares without wanting to push the price higher. They're buying quietly.
And distribution, the selling, is just the opposite of that.
It's the mirror image, price moving down on heavy volume. Or the really tricky one, a late-day rally on very thin volume that immediately reverses on higher volume.
Meaning institutions use that last little pop of strength to sell into.
Exactly. They use the amateur's enthusiasm as their exit liquidity. And we use dark pools to confirm what we're seeing.
And dark pools are basically private stock exchanges for institutions to do huge anonymous block trades without moving the market.
That's where the whales operate, yes.
Yeah.
We monitor the dark pool index, the DIX, to try and gauge that hidden sentiment. Generally, a reading over 0.45 is seen as bullish accumulation.
So what were the signatures telling you around the December 5th close?
The signals were decidedly mixed, which honestly reinforces that whole cautious, neutral theme.
How so?
The DIX was just a hair above 0.45, so technically slightly bullish.
Yeah.
But when we looked closer, we saw these clusters of large, late-reported block trades. We're talking 50,000 shares or more in defensive sectors.
Ah, so staples and utilities, not tech.
Exactly. So while institutions were slightly net positive buyers overall, they were using the cover of dark pools to quietly rotate out of the recent high-flying growth names and into safety.
So that's caution, not conviction.
It is. It's a subtle, quiet risk reduction. They're selling growth into strength and reallocating to defensives, all without tanking the public market price. It confirms that underlying tension.
Okay, that brings us to the future. Let's shift entirely to positioning for Monday. What's the framework for identifying those asymmetric setups, where the potential upside just massively outweighs the downside risk?
Here, the focus shifts completely to market structure, and specifically to options-driven dynamics.
Yeah.
You're looking for areas in the market where a small push can create a massive shove.
Forced selling, basically.
Forced trading behavior. First, you look for liquidity traps. Think about illiquid pockets like small cap growth or maybe some high yield credit where the average daily volume is really dried up.
Low volume amplifies every move.
Massively. If bad news hits one of those names, a small bit of selling can turn into a flash crash. It's a trap for anyone late, but a huge opportunity if you're positioned for it.
And this leads us to the concept that really dictates short-term moves. Options, gamma levels. Explain how these become price magnets for the entire index.
Right. So gamma levels come from the huge open interest in index options, like for the S&P 500. These levels basically dictate how dealers, the folks selling all those options, have to hedge their books in real time.
Okay.
The most important level of all is the zero gamma level. This is the strike price where the market's overall gamma flips from positive to negative.
And above that level, dealer hedging actually dampens volatility.
It does. It acts as a cushion. In a positive gamma environment, dealers are forced to sell into rallies and buy into dips to stay neutral. Gives things calm.
But below that zero gamma level, that's when things get dangerous.
That's where the accelerator gets floored. Below that level, dealers become short gamma. They're forced to do the opposite. They have to sell into weakness and buy into strength just to manage their risk.
Which creates a feedback loop.
A catastrophic deleveraging feedback loop. It's what turns a small drop into a huge one very, very quickly.
And we also have to watch the walls, the call walls and put walls.
Right. A call wall is a huge pile of call options above the current price that acts like a ceiling. A put wall is a huge pile of put options below the price that acts like a floor.
And breaking through that floor is the real fear.
Breaching a major put wall is what everyone is terrified of, because that's what can trigger that negative gamma loop and the rapid downside.
So the asymmetric strategy is to be positioned for that break.
Absolutely. The whole game is being positioned around these levels with options. For example, if you see the VIX term structure flattening signaling, rising risk, and the index is drifting down towards a big put wall, buying some cheap out-of-the-money puts gives you that perfect asymmetric payoff. If the wall holds, you lose a small premium. But if it breaks,
the forced selling and volatility spike give you a massive return.
For a very small defined risk, that's the setup.
That perfectly captures the tension. The market looks stable on the surface, good liquidity, a low VIX. But underneath, the rally is narrow and institutions are quietly de-risking.
They're preparing for a shock without tipping their hand to the broader market. That neutral sentiment, coupled with a narrow base, is so deceptive it just masks these huge structural imbalances.
So here's the final thought for you to explore as you get ready for Monday's open. If that moderately flat VIX term structure suddenly runs into a major breached put wall, let's say the index gap's down 1.5% at the open, how quickly could that forced selling spiral, given how narrow this rally is, and where might you spot that first crack? We'd recommend you watch a more sensitive sector VIX like the RVX for the Russell 2000. It often leads the way down. Thanks for joining us for this deep dive into the market plumbing.